Welcome, everyone. Thank you for joining us for the webinar today. Today's webinar is focused a lot on the healthcare professionals, doctors specifically. It's a topic very close to my heart. My dad is a doctor, and he's not good at investing or tax. I don't think he would mind if I say that publicly. He's very far from it. He's great at earning it, but not great at then managing it, not because he's not smart, because there's just a lot new changes, regulations, and there isn't enough time. So we would want to do our bit to help the industry professionals in this space. And with that intent, we invited Mr. Anil Sharma, who's the president of A4 Tax and Accounting Professional Corp. He has over 20 years of experience in tax planning, tax prep, accounting services. He's a CPA, certified general accountant, and of course provides a wide range of tax planning, tax prep services across GTA. He's our advisor, and he's the smartest accountant we've known, or at least I've definitely known my entire life. Comes highly recommended. So welcome, Anil, to the webinar. Really excited to know what you would like to share with us.
Thank you, Khushboo. Thank you so much for your great introduction. You're very generous with your words, always. And thank you so much for having me. And welcome everybody to the webinar. And I will share some of the key areas or key points that are relevant to the medical professional about their tax planning, their tax preparation, and hope that will be helpful to all of you. I will start sharing my screen now, and we will go through the presentation. Any questions, feel free to ask or during the presentation or even at the end, and I'll be happy to answer. Let me see if I can make my...
I hope so. I'm always worried that as a tech company, we sometimes miss out on some of these things, and
right.
If the sharing fails, it doesn't speak highly about us.
Yeah, that's right. Okay, let's see. Can you see my screen, Khushboo?
Yes, I can see.
Okay, that's good. So we passed. Okay, so a few topics that we'll be covering today will relate to business structure, what are the tax benefits for incorporation, tracking the expenses relating to the business, conferences. Many doctors ask me about those, so I thought I'll include that. Income splitting, how that can be achieved. I see a lot of doctors creating a holding company / investment company for the excess cash flow. I thought I'll talk about a little bit on that. Then with the investment, there comes the grinding down of small business deduction. So we'll talk about that as well. Along with that, what can we do to minimize the impact of passive income? That will be another topic I would touch on. And finally, the questions. What I have seen, main three types of structure in the medical practices. One is obviously sole proprietorship. The doctor practice with in his own name, no formal business entity created. In that, obviously, whatever is the gross income coming into the business minus expenses, the remainder becomes the income for the doctor, and the taxes are paid on the applicable marginal tax rate depending on their income. In this scenario, whether you use all of your income or not, you are paying taxes according to your personal tax rate. So there is no deferral available except if you put some money into RRSP. Second structure that I have seen people using are the partnership, where more than one people come together and run a clinic. They are not incorporated. They are both operating as themselves. So that's a partnership. For tax purposes, partnerships is not a tax entity. So what happens, all the expenses are tracked and allocated to partners' income, and the remainder income is declared by the partner on their personal tax returns. and they pay tax accordingly in a similar fashion as a sole proprietor. The last one is incorporation, and that's where I have seen a lot of people doing that and heading into that direction for a few reasons that we will touch upon. And corporation is a separate legal entity. In case of doctors, it will be a professional corporation, you know, done in accordance with the rules laid down by your governing body. And the corporation, as you may all know, have a lower tax bracket. That's why people prefer doing the corporations. As mentioned earlier, some of the benefits for the incorporation, obviously, there is a reduced tax rate on the profits up to $500,000. For Ontario, it's only 12.2%. Any income exceeding that $500,000 is taxed at a higher rate, which is 26.5%, but still way below the personal highest marginal tax rate, which is 53.5% in Ontario. When there is a corporation involved, you can manage or plan the actual salary or dividend taken out from the company so that the tax situation is optimized for the corporation and personally for you. As a shareholder, you could take as a dividend income, or you could take it as a salary. Some people like dividends, some people like salary. Each of them have its own advantages and disadvantages, but you have flexibility there. Also, you can choose how much amount you want to take. You don't have to take all of the money out of the corporation. If you take all money out of the corporation, then the very purpose of creating a corporation is defeated because there is no tax advantage in that. Income splitting can also be achieved by doing the corporation. If there are some family members who are in the lower tax bracket, and if they provide any service to the business, you know, assisting you in scheduling the appointments, doing admin works, or doing your bookkeeping, or, you know, those things, then you can pay them a reasonable salary. And if they work in the practice for more than 20 hours a week, you can actually pay them dividend as well. So that's a great way of achieving income splitting amongst the family members. Another benefit is tax deferral, because corporations pay taxes at a lower rate as compared to personal tax. Any money retained in the company can be invested within the company and be grown there, and on those profits, tax is deferred to a future date.
Question for you, Anil, on this one.
Yeah.
Some of these incorporation benefits, would they be true for any professional, or are they specific to medical doctors and healthcare professionals? For example, say if my brother decides to do a contract work as an investment banker, would he also benefit from similar tax benefits, or is it specific to a medical practice?
It is not specific to the medical practice. These are applicable to all the corporations.
Okay.
Right? And as long as the corporation has an active business, the tax rate will be 12.2% for that corporation in Ontario, up to $500,000 of profit. Similarly, in case, you know, like you mentioned about your brother, so if he has other family members who are in lower tax bracket, and if they are helping him to run the business, then a reasonable salary can be paid to those family members according to the work they have done and what would you have paid to a third party if that services were rendered by that third party.
Got it. And in this last example, where a family member is rendering a service to that corporation, that expense then is treated as an expense because it's a payroll expense.
Yes.
And so that's then coming out of the profit, basically.
That is reducing the profit. That is reducing the profit of the company. And the person who received the income will have that income on their personal taxes.
Right.
Right. Right. So any other questions so far?
No.
Okay. So now the next very important thing is tracking the expenses. What I have seen, as you mentioned, medical professionals are very busy professionals. They are busy doing their work, and in that process, sometimes not all the expenses are tracked. Some expenses are missed, or the bookkeeping was not done right. So it is very important that all the expenses are tracked properly and claimed on the tax return to optimize the tax payable. If we miss the expenses, then it means we are paying tax on a higher income, ignoring those expenses. Some of the expenses that are very relevant for medical practices are, professional dues and subscriptions, their medical malpractice insurance, office insurance as well, rent and utilities, any equipment that are used in the practice, office supplies, medical supplies, professional fees paid to the legal professionals or accountants or any other person who is helping in promoting the practice. Those things can be claimed, and obviously the staff wages, and if the shareholder is taking salary, those salaries. So need to keep track of all those expenses properly and claim those on the tax return. Always keep detailed records of whatever expenses are being claimed, and records mean we should have the invoices and also the payment proof. Invoices has to be obviously in the name of the business itself and issued properly by the supplier, and the payment proof could be either the credit card payment or the e-transfers, or if the checks were issued, those are all acceptable as a proof of payment. Many doctors have asked me in the past that they attend these conferences for their continuing medical education and professional development, and so they ask, okay, what can I deduct about the conferences? The short answer is anything and everything relating to that conference, as long as it's directly related to attending the conference, pertaining to your continuing medical education or professional development, you can claim them all. As long as you keep your records properly, you are able to prove that, yes, this was actually a conference for the professional development, not a vacation. They are all claimable. What CRA look for is that it should be a reasonable expense. It's not that your practice is, let's say, $300,000, and there is a $50,000 conference bill. They will look at it and say it doesn't sound reasonable. So they have to be reasonable. Then general expenses are registration fee, the transportation. If it's out of station, obviously any airfare, train, or if you are driving yourself, maybe claim a mileage on that. Accommodation and meals. Those are the expenses that normally can be claimed. If the conference is in the same city where you live, then accommodation will not be allowed. Then you can claim, the other ones: registration fee, transportation, or meals expenses. Those can be claimed on that one. And very important that they must relate to your profession, and they must be for your professional development. Any non-educational thing, if you have any cultural event or any networking event which is not a professional related, that will be taken out. That will be taken out and will not be deducted. For meals, 100% is not allowed. It's always 50% for any business. So same rule apply here too. When you're going for the conference, 50% of meals are deductible. The other ones are not. And again, all the supporting document must be kept in case of any review. CRA is very, very sticky on these, and they would like to see the copy of all the invoices and proof of payment. Income splitting, yes, as mentioned earlier, paying a reasonable salary to the family members for whatever services they are rendering. What is reasonable? Look at it in this fashion. Same work done by a third party, what will you pay that person? that is reasonable for paying to your family members. If family members are involved in the business and actively working more than 20 hours a week, they can be added as non-voting shareholders, and instead of salary, they can be paid dividend from the business. It's very important, again, to keep the records for their involvement, like what duties and responsibilities they have, time sheets for time they work, and obviously proof of payment. So they should be paid regularly like any other employee. Maybe, if you are doing a monthly payroll or bi-weekly payroll, it's better to do that on the same fashion even for the family members, so that it proves its legitimacy and integrity of the system. In the professional corporation, you are limited what other activities can be done by your governing body. So most professionals, what they do is any excess cash in their professional corporation, they move that cash to another company, which is an investment company essentially. In common parlance, people call it holding company as well. What it means is that you move the money there and do your investment through that company. Why people do that? If you take all of that cash out personally, you will be paying tax on your personal tax rate. When you move the money from your professional corporation to the holding company, it can be moved without any tax incidents. So you don't have to pay tax at that point. Yes, you will be paying tax on whatever you earn on the investment, but for moving money from the professional corporation to the investment company, there is no tax implication.
What's the relationship between the investment company or the holding company and the original professional corporation? Does it need to be a subsidiary of that, or it could be just another independent corp?
It is another independent corporation. It's not a subsidiary company. Okay. So the same professional own both the companies.
So when you do the taxes for the original professional corp, say if you move 100,000 to the investment company,
yeah,
what is that movement treated as? Is it treated as an investment?
It's an intercompany loan.
Intercompany loan.
Yeah, it's an intercompany loan, and there is no restriction on intercompany loans. You don't have to do any interest charges between those two companies because they are both related and connected corporation. So there is no interest charged or paid by either, and there is no tax incidence. It sits as a loan receivable on the professional corporation and loan payable on the investment/holding company.
Got it.
Right. And once the money is there in the holding company, it can be invested wherever the person is comfortable with. Whatever investment they want to do, they could do a real estate investment, buy the real estate and hold, or they can invest with BuyProperly, because you are the leading real estate investment company, which provide opportunity to all the public out there. So that could be another option. Or people can invest in stocks, mutual funds, or whatever investment they like, crypto for that matter.
Got it. Yeah, we have quite a few medical doctors investing through our platform because it's easy and not time consuming.
Right.
It's simplified.
Yeah, that's right. And basically, it's like buying share of Apple and not do anything, but earn the rewards, right? So yeah, invest with you guys, and then you take care of all the nitty-gritty, all the admin stuff. And so that way, yeah, that's a good opportunity. And that holding company, what it does, it opens the doors to various opportunities. As I mentioned, you could have variety of investments in there according to your own risk tolerance and time horizon, what you are looking at. You can do that. It provides asset protection as well. There could be some liability issues on any front, right? So then a holding company being a separate company, it provides an additional layer for the liability protection because it's a separate business from your professional corporation or your personal thing. So that's another thing you could have. So those are the benefits of holding company and investment company.
Can this
Now,
holding company be a family trust? Sorry, Anil, you were saying something.
Well, family trust is a different kind of entity, right? It's a different kind of entity, and corporation by itself is a separate legal entity.
Got it.
Yeah, right. And when it comes to family trust, so family trust can hold the share of holding company, but it cannot hold the shares of professional corporation.
Right. So,
Right?
but could you do an intercompany loan to a family trust? Like, can the family trust
No,
act like the
no, you
investment
can't.
company?
You can't. You can't loan the money to the trust. No.
Okay.
Yeah, that will be a different thing. So it will be, yeah, intercompany loan can be done, but not the family trust.
Got it.
Right. Yeah. So, well, trust itself is a different topic, and it can be another webinar, full webinar dedicated to the trust.
Fair enough.
Yeah.
We have a question from somebody from Bogdan. I hope I'm not butchering your name. For profit under, I'm trying to read the 500,000, Ontario tax is 12.2%. What about federal tax? Is 12.2 combined Ontario and federal, or federal is in addition to Ontario? And if yes, how much is the total tax rate for profit under 500,000?
Right. Very good question. 12.2% is a combined rate. Out of 12.2, 9% is federal and 3.2% is Ontario. So that's the total tax on the profits up to 500,000.
Got it. Cool.
All right.
Thank you.
No problem. Any other questions?
That was the only one for now.
Okay, very good. So with the investment income, there is something called grinding down of small business deduction. As we all know by now that up to 500,000, the small business, a corporation that you own, is entitled to the 12.2% tax rate, which is a preferred rate. However, if you have an investment income, whether it is in the professional corporation or whether it is another associated connected corporation like a holding company, if the investment income exceed $50,000, it start grinding down that small business deduction. What it means is if your investment income is $150,000, then it will reduce your small business deduction to 0. So you will not have that 12.2% preferred rate because you have investment income in excess of $150,000. For Ontario, it's not that bad even in that case, because what happens, Ontario itself does not participate in this grind down. It's only the federal tax which goes up by 6%. So even after this grind down, your total Ontario tax up to on an income up to 500,000 will be only 18.2%. So it's not bad, but if possible, we should try and avoid that. We should try and work on some strategy so that our investment income does not go as high so that we lose that deduction.
What could you do?
Yeah, go ahead.
No, what could you do? You said you could do some strategies.
Yeah, you could do some strategies on that, and we'll talk about on the next slide. We'll talk about on that next slide, and that's where we will deal with that. Now, for this investment income, which I'm talking about, they are normally, the dividends, interest income, rental income. royalty income, and some capital gains. Not all capital gains are grinding down, but most of the investment related gains will be covered there. But if the capital gain is on sale of active business assets, that will not grind down this.
Got it.
Right? And passive income, when we talk about passive income, it's not only from the professional corporation, but even other connected corporation will be combined to calculate this small business grind.
Okay.
All right. Now, these are some of the things which we can do to reduce that impact. We can invest in assets which are, more growth oriented rather than, having regular interest or dividend income. So as long as those assets are held and not sold, there is no investment income coming in. So that will not impact. And as mentioned earlier, that could be one of the strategies, to invest with BuyProperly, right? So you invest, buy and hold, and if the investments are geared towards, capital appreciation or growth, then small business deduction is not impacted by that. Another thing can be done is, withdraw a little higher amount from the corporation to maximize your RRSP contribution and TFSA contributions. By doing that, you remove some extra cash from the corporation. And if you have lesser cash in the corporation, obviously that means lesser investment income. There could be opportunity to withdraw tax-free money from the corporation. Examples are initially, in any business, shareholder invest their own money, and there may be an amount owing to the shareholder sitting on the corporation books. If you have cash in the company, pay down that shareholder loan back to the shareholder. There's no tax implication on it. And that will remove cash from the company. And if there's no cash, obviously there's no investment income. Another thing could be if there are some capital gains, you have invested money in the corporation, and in past year or before you have capital gains there. So half of the capital gains are taxable, and the non-taxable capital gain create a capital dividend. If you have that opportunity, you should try and take out the capital dividend. It's a tax-free payment. So there's no tax applicable on that. There could be an IPP, individual pension plan, or maybe a corporation-owned insurance policy, which has investment component to it, because anything earned within the IPP or the insurance policy are not flowed back to the corporation. They stay within those, investments, and they don't impact the SBD. And that's all from my side. Any questions, you're welcome, and I'll try to answer those.
I don't know if there are more questions. I did have one question, Anil, and maybe to your point.
Yeah.
We probably need a separate webinar altogether. But there are so many tax strategies that you could employ to ensure that you are optimizing your investment income. Like you talked about how doing more capital gains versus regular income, it helps not doesn't grind down the small business deductions. Are these true only for professionals, corporations, or would they vary between the type of corp, whether it's a partnership or family trust, a holding company, or usually they will be similar?
So a family trust or partnership, they are totally different thing, right? Okay. But the corporations, yeah, they are applicable to all.
Okay.
Yeah, these strategies are applicable to all the corporations.
Got it.
They can take advantage of these.
In some of these tax strategies, like I'm sure they come with their own risk return profile. So if you're investing more in growth, it's obviously higher risk than regular income.
Right.
And so how does a regular person, like, for example, if I wanted to decide where to put my money, how do I decide what's best suited for me other than asking you? Are there
Well, that's where the professionals come, right? I mean, whatever the field, if the investment related, then obviously I'll ask an investment person.
Right.
Right. I mean, I can talk about the taxes, but again, if the investment thing comes, then I would ask you, okay, what do you offer? Or I would ask another advisor who deals with the investment type of investment I'm looking into.
Got it. There's another question from the audience. This is from Dr. Shivakumar. What is capital gain stripping? And can you explain in plain language, how many times can you do capital gain stripping?
Dr. Shivakumar, there is no limitation on how many times can you do it, but it must justify the cost, because capital gain stripping is an expensive exercise, and unless you have a substantial amount of capital gain, the cost may not be justified. And to explain in a layman language, it is basically turning the regular profit. When you take money out of a corporation, normally it can come out either as a dividend or salary. But when you deploy a strategy to convert that regular income into a capital gain, that is capital gain stripping. It's a complex process, involves more than one corporation to be created, and it cannot be explained just like that on a webinar. But it can be done. There is no limitation how many times you can do it. By the way, Revenue Canada is looking into that, and they are trying to plug that loophole. And there are a lot of people doing that now. So yes, it can be done, and there is no limitation how many times you can do. I have seen doctors who have done multiple times over a period of time, but again, it depends on how much money we are talking about.
Got it.
Okay.
Thank you. Yeah, those are, I think, all the questions. So if there are no more questions, then we can call it a day and give people time back.
Yeah.
Thank you so much, Anil. I feel like I always learn so much in every session from you. I know I ask a lot of questions as well, but yeah, I feel like I'm educated a little more in the tax world. Thank you.
Thank you so much, Khushboo. Thanks for having me. And thank you, everybody, for attending the webinar. I think we have a question there.
No, I think Dr. Shivakumar was saying thank you to you.
All right. Okay. All right. Thank you, everybody. Have a good afternoon.
Thank you. Bye-bye.